Hi, John Dobas from Forbes here at the Money Show in San Francisco with Tom Grimes at Reeves Asset Management in Jersey City, New Jersey. They've got funds that cover, you got an ETF that does the utility sector, you've got telecom, energy. I pretty much hit it there. The common theme there is what? High dividend, steady growth companies?
You know, we like essential service businesses. So everybody gets up in the morning, you got to turn on the lights. You need power for all your devices today. You need to put still, maybe not for, maybe 30 years from now it'll be a little different.
Gas in the car?
Putting gas in the car.
Right.
Or
plug it in, so that would be good. That'd be you too.
And we need natural gas to heat our homes in the winter. And then, of course, the internet and the broadband pipes and the companies that provide those services are important too. So the common thing is networks.
Right.
Highly capital-intensive businesses. Some of them highly regulated, but they've managed to navigate all the different environments that they've had to deal with and earn money, pay dividends, raise the dividends. Those are the companies we're looking for in our portfolio.
So utilities, if you've been watching live on Facebook, you probably saw Tom talking about utilities just a little while back. If not, scroll up your page and you can see that video. But some of the other companies, do you have like a Verizon and AT&T and those kinds of companies in the portfolio?
You know, in our history, when AT&T spun off the Bells way back in 1984, those were our biggest holdings.
Okay.
Those telephone stocks were almost half our portfolio. They were cutting costs, raising the dividend, they were getting into the wireless business. It was a tremendous run from 84 to the late 90s. They got very expensive. They went from single-digit price-earnings ratios to price-earnings ratios above 20. They went from high single-digit dividend yields to 2% dividend yields. We cut back dramatically in '99 in the telephone space and started focusing more on our utilities and energy stocks, which had a good run. We've moved back into communications, but Verizon and AT&T are much smaller positions. They're facing a lot of competition in the wireless space from Sprint, T-Mobile.
Sure.
And obviously the market's gotten very saturated. So those businesses aren't quite as good today, although we think the dividends are still fine, but they're just not raising them that fast. The cable stocks, though, have done very well the last 5-6 years.
They have. And we were speaking about this before we came on about, you know, the idea that a lot of people are cutting cords, getting rid of your TV service from your cable company, but you do keep the internet because you've got to get on the internet somehow. Let's talk a little bit about cable companies. I know that there's been a lot of defections as far as the TV service goes, and in my mind, I'd think, because I don't think much, I guess, that it would be a bad investment. But tell me how I should be looking at it.
The largest cable companies in the country are very well managed, and some of them have diversified. Comcast, for example, bought NBC a few years back.
Sure.
So they have a play on content as well as a play on the network. They've managed, yes, while we have received a lot of publicity about cord cutting, actually the rate of decline in their video subscribers has slowed in recent quarters, so that may be an overblown fear somewhat. In any event, the highest margin part of their network business is that high-speed broadband connection, and they can still do very well even as the video subscribers start to decline. The same way the baby bells lost wireline customers. My wife and I moved to a new house 7 or 8 years ago, and we went just mobile, no wireline phones. But Verizon and AT&T have been navigating that type of environment for a long time, and they're still making money.
So talk to me about energy. Energy, you seem to be at the mercy of a commodities market that determines the price of the thing that they sell, oil or natural gas. Where do you find value there now, and how do you know if it's real value and not just something that will get even cheaper?
The key is focusing on the companies like we do that have just a rock-solid balance sheet and capital structure and have been able to cut costs to deal with the new oil price environment. So, in June of 2014, we were over $100 for a barrel of crude oil.
Yeah, that came down quickly, didn't it?
WTI, and we got as low as the mid-20s. We're back in the high 40s, right around 50 now. And it looks like it's stabilizing at that level. What happens, though, is capital expenditures drop dramatically. So when you get a few years out, all the spending that's not being done today for new production, that new production won't be coming online. So supply and demand will start to get a lot more in balance, and we could end up being a little undersupplied. And if demand keeps growing, globally it's only about 1% a year, but that's still enough. And you have natural decline of almost 5% a year. So the oil companies have to reinvest just to keep even with what they produce.
The reserves, right.
So it looks pretty negative now. The prices have come down a lot, but we think there's opportunities in the coming years.
How about refiners? Are you into that space?
It's not an area we've liked. We're not crazy about the business models. From time to time, they have good runs, but
then they don't for some time, right?
We like the bigger, more diversified, integrated players more, where we do get some refinery exposure.
You're talking the XOM and the CVX and all that kind of.
Royal Dutch Shell, those kind of names. Yeah.
BP. So overseas oil companies too, or something that you guys take?
Yeah. Well, usually U.S., UK, Canada is about as far as we go internationally.
Well, if you want to go into energy or telecom or utilities, this is it.